Good morning. Happy New Year to all of you. And I hope this is a year that will push us to greater strength. From strength to strength, we need to move. And today we will cover the standard presentation in terms of the discussion that took place yesterday, the Monetary Policy Committee. And after that, we will, as Wallace just told us, open it to Q&As. So in general, the inflation remains stable and within the range, our target range. And this is despite significant increases in the food prices. This went up by about 9% in December. And again, it's the standard products that we talked about last time: tomatoes, onions, and then of course maize and maize flour. All those obviously, or some of them are, at least the tomatoes, onions, and things like that, are being driven by the excess rain that we have been seeing. And we know what has been happening with maybe we don't know what has been happening in the maize sector. We know that is a significant sector. There are problems in that sector, as has been mentioned recently by the president, and obviously you are well acquainted with those things. Non-food, non-fuel inflation remains below 3%, low and stable. So inflation expectations are well anchored. As a matter of fact, the survey that we undertook, the MPC survey, the respondents flagged the continued rains and potential harvest losses as the concern. So exactly as I have mentioned in terms of tomatoes, onions, and other products like that. Global economic outlook. This is looking worse by the month. The IMF revised its forecast earlier actually a week ago, on Monday, on the 20th, and lowering their estimate of global growth in 2019 and also the forecast for 2020. Both were lowered by 0.1 percentage points, and therefore the growth estimate for 2019 is 2.9%, and in 2020, 3.3%. Frankly, this is the worst outcome. That is the outcome of 2019. The worst outcome in global growth since 2009. 2009, we had minus 0.1. And then before that, you have to go to 2001 to get 2.5%. So you can see things, no matter how you slice it, things are not looking great in the global economy. Now, there is obviously some positive sentiments that was injected into the economy earlier this month because of the conclusion, or should we call it the Phase 1 agreement between the United States and China. This is, if you will recall, was related to their trade war, or the disagreement that they were having on trade. And so they did get an agreement which was signed, and that was so-called the Phase 1. There are other things that still need to be dealt with. But that obviously injected a sense of optimism, because the sense before that was there may not be a conclusion. But be that as it may, there has also been significant downside risks that remain prominent. And this include, of course, the continuation of more trade wars between the US and China, the geopolitical tensions that we have seen, Iran and other places like that. Brexit has still yet to be resolved. Yes, there will be something later this month. So we are talking the end of this week. But still, there are significant uncertainties around it. And other factors, including even the stance of monetary policy in the advanced economies. All these mean that there's, or they have, they indicate, or they continue to show significant downside risks. On top of that, there's one other issue, which is the outbreak of the coronavirus in Wuhan, China. We all know what has happened there, and obviously there's a significant human cost to it and the human life. But beyond that, there is the concern in terms of the economic impact of that. That's the containment, the measures to contain the virus. So basically, in one sentence, there are many uncertainties and also potential triggers to a significant, let's say, downturn in a rather fragile economy as we see it at the moment. As a matter of fact, just yesterday, in the advanced economies, and in particular the New York stock market, and indeed the New York markets, they actually, they took a hit. In a sense, there was a sense of a correction, mainly driven by the reaction to the corona virus, that the news about that, and actually that some people had been, or there were people in various cities in the US, that in particular Chicago, but other places as well, that had come down with this virus. So a lot of negative reaction in the markets to this. So that's the global economic outlook. Not good, but at this moment, a lot of risks. What about Kenya then? Kenya, the external sector. The external sector remains or continues to improve. The current account deficit is estimated in 2019 at 4.6% of GDP, which is lower than the 5% that was recorded in 2018. Now, if you look at the details of the balance of payments, what you see is that in 2019, it reveals that exports as a share of GDP, so if you measure things as a share relative to GDP, exports fell, but imports fell even more. So it's important to see that. Now we are talking obviously as shares of GDP. So in terms of exports, as a share of GDP fell by something like 0.8 percentage points, and imports fell by 1.7 percentage points of GDP, that is. Basically, that's how we ended up having a contraction in the deficit of the current account. I don't want to go into the details of exports and imports and so forth, but suffices to say on the export side, tea and horticulture have not been doing too well towards the end of the year. At the beginning of the year, they were doing well, but towards the end of 2019, they weren't so hot. Imports, on the other hand, have continued to contract, largely driven by the reduction in SGR-related imports with the completion of that project, at least the large imports related to that project. Remittances hit an all-time record. This is at, the number is 2 billion 7, well, let's just say 2788 million. How is that? 2788 million US dollars. That is the amount of remittances, our estimate of remittances in 2019. And this is actually about 50% of merchandise exports. I mean, by, far and away the largest sources of our inflows is now remittances. Now, I want to also mention that we have, the foreign the current account deficit has been fully financed, FDI, and also portfolio investment. And I think it is important to mention that actually FDI has come back. There was if you look at, say, over the last 15 years, around 2007, there was a surge in FDI. And that surge related to specific projects that were being undertaken. For instance, the investments in the geothermal projects, windmill, and things like that. So there was a lot of inflow in FDI to deal with those large projects. And also, should we say, the oil exploration, a lot of large investments to deal with that. But then it has come down from that rather unusual level. It has come down in terms of percentage of GDP back to a level like 2% of GDP. And that's where we are. So we are around 2% of GDP, and that is partly financing the current account deficit, which we mentioned a moment ago, of 4.6% of GDP. I think that's the number I mentioned. So FDI continues to come. I think it is important to also talk about the diversity of FDI. It is quite diverse. And I think here is a case. There is actually an interesting story about where the FDI is coming from. By the way, if one thinks of all the trips that take place or all the conversations that maybe we have, yourselves included, with foreign investors, I mean, a lot of it will be coming as foreign direct investment for many reasons. But there is also the portfolio investment. This is investment, say, in our government securities, or for that matter, in a stock exchange and things like that. And that is also coming. What is interesting is that actually it's quite likely that you'll see a larger and larger proportion of diaspora ending up, investing in our securities, meaning it will be coming in, since they are, even though they have a Kenyan passport, their jurisdiction is outside this country. So that will be coming in as portfolio investment. And so don't be surprised with time to have not so much a decline in remittances, but a stabilization in remittances, but an increase in FDI that is related to people we know. Meaning, instead of them sending remittances, they will be putting investments in the government securities. It's a dynamic that we want to see this year, but it is something that already we can see. We can see it in nascent form. One other thing I wanted to mention about exports and trade is just to give you two numbers. This is with regard to the direction of trade. So the East African Community trade, this is exports to the rest of the East African Community, accounted for 23.4% in 2019. So you can see we are very local in that sense. And then we have, for Africa, the rest of Africa, I think this is sub-Saharan Africa, accounted for about 37.5%. So the point here is to stress the regional orientation of our trade. This is important going forward, particularly when you're talking of the African continental free trade area. This is important. And also you can see it has a stabilizing effect. The rest of the world may, if there are problems in the rest of the world, at least around us, there's some stability. And therefore, we won't have as much concern as if, for instance, 90% of our exports were going to a particular country or were going to the advanced economies or something like that. But I wanted to tell you that because, in a sense, it offers a sense of security because of the diversification that we have. Obviously, it doesn't mean that we should rest on our laurels. Of course not. But it is important to see where our risks are and maybe where our strengths also are. So, bottom line, foreign exchange market remains stable. I've talked about the contraction in current account, and the flows, they are very balanced. And we expect that this will remain stable in 2020, when we expect the deficit to be, the current account deficit to be around 4.7% of GDP. I think I have explained it a lot now, severally, that actually the current account deficit of around 5% of GDP is, I want to call it a sweet spot. You know, it's more or less where you could say, yeah, that's a good place for us to be as Kenya. Okay, let's move on to other things. As you all know, in any of these things, we could talk virtually all day about any of these things, so it's better to move on. Banking sector, this remains resilient and stable. Liquidity risks continue to ease, and obviously there's better distribution of liquidity in the sector. Also, credit risk is easing. NPLs to loan ratio has fallen to 12% in December, from 12.3 in October and 12.6 in August last year. And almost half of this decline has been due to write-offs, or rather it has been 50-50, split between write-offs and also recoveries. So you can see there has been, let's say, there's been fruit, there's been, the banks have really gone on an aggressive campaign, aggressive recovery, right? And been working on that, and you can see it's bearing fruit in this regard. Now I'll talk later about, well, maybe I should mention also there is, with regard to operational risks, this is something that we have been very much, let's say, aware of. And banks also, commercial banks, have been alert, particularly now you're talking things like cybersecurity or other things. By the way, you know, around December, that's when you have a surge in, in sort of cyber crime and things like that. For the same reason that you also have a surge in house burglary around that time. I'm sure this is your experience. I mean, because you travel, and so you leave home and people know you've gone and all that. So in the same way, the cyber crooks believe that this is an opportunity that they can exploit. Anyway, the banks obviously are wiser, and or they have wisened up, and we are not just talking Kenya, we are talking around the world. And so they too, just like yourself, that is when you set up your house alarms and whatever it is, and therefore you minimize that risk that would otherwise have been come to pass. We'll talk about other things in the sector, but I think it is important to mention that there's a lot of transformation that is taking place in the sector. And I think for those of us that, let's say, are impatient, then maybe this is not the job for them, because the transformation is not about a single iconic moment where you can say, yes, this is the mark that let's say characterizes the transformation. There's a lot of hard work, a lot of grind, and so, for instance, in the interest rate, post-interest rate regime, we've made the point that there has been significant transformation, and we've explained ourselves what is it that we are seeing and how we are dealing with it. And just to share, don't miss. So in the post-interest rate caps regime, obviously we have been working with banks even before, trying to explain to them and actually working with them to understand what still remains for them, so as they can move to the next level, the transformation that we have talked about in our economy. By the way, we did write an op-ed piece that some of you published, but if you haven't seen it, it is on our website. And it is all about, why this time it's different. Why is it different this time? Meaning, why is it that we do not expect, after lifting of the caps, that banks will go back to the same old Wild West sort of maneuvering? And I think even though I say it myself, I think we explain it well. What is it that we are saying? But what is clear is that we have been working with each of the banks, and we have been working in the context of the banking sector charter, and they have to come up with a plan. Indeed, even make presentations to us, but also have agreement and presentations to all levels of the bank, meaning including to their board. And the point is that, which is the issue I want to stress, we do not expect some sort of random, let's say, model, where they say, okay, this is for instance, how is it that they are going to assess that this individual has a certain risk profile? I mean, it cannot be a random number. It cannot be a random, let's say, model that does that. So it has to be a robust model. So we don't want just to throw it back into a black box. I hope we understand what this is. This is important because that's really where everything will stand or fall. And that's why we need to work with them to be sure that they have a robust, let's say, model, a robust mechanism that actually delivers what they claim, or what all of us in this room and everywhere else, indeed every single Kenyan, wants. I've given the example of the chicken farming. I definitely need to be more risky, more risky in a sense in terms of chicken farming. But maybe a chicken farmer should actually be assessed at a lower risk. And the model should be able to deal with that. You understand? And that's really the point. So we've been working with them. But in terms of the details, I'll just say that so far we are content in terms of the progress we are making with the banks. And I'm sure that customers also should be content with the progress that, or indeed how things, the evolution of the evolution in the banking sector. That's what I want to say for now about that. Talking about transformations in the sector, I would also say that there has been significant consolidation, and you've seen some of the numbers, some of the announcements. Actually, in my last count, I have 8. So I don't know if you have 8 in your count, but I have 8. So if you don't know the 8, then later on I could tell you. The most recent ones were KCB and NBK that we know. Then even more recently, there was the CBA and NIC. And then the last one that was announced most recently is Access of Nigeria acquiring Transnational Bank here in Kenya. So those are the last ones, but that's number 6, 7, and 8. If you are missing the first 5, then I could tell you that later. But it is interesting to note again that it's not a single iconic moment. It is actually a lot of work that actually happens. And the announcement is really the final, it's really that, an announcement of a successful consolidation, should we say a merger or acquisition and things like that. Okay, let's move on to the other items. I'll say very little about the MPC survey. It was there, but I don't want to, I mean, here I think you'll see a lot more when the document is published, except to say inflation is well anchored. At least that is one of the respondents did indicate that in their responses. And there's still a lot of optimism. Actually, the level of optimism has not changed since November. So banks are 92% optimistic or very optimistic. And as for non-banks, 72% are optimistic or very optimistic about the outcome of the economy, meaning looking forward. Now, I want to mention a few things that I generally don't in most presentations. So this is the surprise part of the presentation. First, I want to say a few things about fiscal, the fiscal developments, and I'll point you to the details that are available in the budget. It's called BROP. I don't know what it means. So somebody can tell you what BROP is. B-R-O-P. It's budget something paper. Budget what? Okay, so whatever. You know, BROP. There are some things that somehow register in acronyms, and you don't know what it means. And this, for me, is one of them. But it is available on the National Treasury's website. And it indicates a few things, but I'll just summarize some things. Not all of them, but just highlight some things. First, in terms of revenues to December. The number there, they collected 920.6 billion against a target of 1,059.3 billion. Now, that obviously is below target. However, remember they were starting from let's say a very bad situation. So even as it is below target, the growth has grown by about 16%, which last year, we're now talking just the first 6 months. Last year it grew by only 12%. So you can see at least now they are catching. So you could say in nominal terms, meaning as a share of GDP, they are catching up, right? So as a matter of fact, as a share of GDP, it is 8.9% of GDP relative to 7.7% of GDP last year. So I just want to point some things. Even as we mark them against the target, there has been improvement against those targets, but also against what happened before, based on where they were starting. So this is the equivalent, of, we needed to talk about marathon running and things like that. This is the equivalent of somebody who has not been training, who starts training for a marathon or any of these things. Obviously, when you start, you cannot even finish 10K. But with time, you begin to finish 10K, and it begins to feel okay. And so you will get to finishing the marathon. So it's that direction. The direction is right. And the numbers are moving in the right direction. And this isn't just a sort of a slight blip in the needle. Yeah? I mean, a movement of over 1% of GDP is significant. So that is important. Expenditures obviously were below target, correspondingly by something like 163 billion. These are all Kenya shillings. And this was both in the recurrent and the development budget. Disbursement to counties was 122 billion, of which 112 was part of the equitable share, and the rest of it, 10 billion, was for expenditure, national government expenditures that the that the counties are actually undertaking on behalf of the national government. So, what is their target for deficit in 1920? So this fiscal year, that is 6.3, and the MPC members looked at the details of this, the presentation, and it, as we said last time, it was credible that in terms of how they are moving, that they could achieve something around this number. So this would be a reduction in the deficit from, or should we say a contraction, from 7.7% of GDP that happened, that was the actual last year. So from 7.7% to 6.3% of GDP. And for 2021, that's the next fiscal year, they are hoping to have a number like 4.9% of GDP. And that is also in the BROP. So that's where we are. Now, pending bills. This also was a big issue last time. And we also had a detailed discussion of pending bills. And I think one can understand why, because it has an impact on the economy. It also has an impact on liquidity. So it is important to be clear as to where this is. And we looked at the numbers, but I want to give you some broad sort of directions here. First, in terms of the national government has virtually cleared all its pending bills. Okay? And these are the current ones we are talking current. It's true there are some historical pending bills which are being looked at by a multi-agency team. So a team that has been assigned specifically to go look at the old historical things, because you never know, there could be a lot of maneno in those things. So a team of people need to look at. But in terms of the current ones, the National Treasury has over the last 6 months dealt with those. So if there's anything, it's insignificant in terms of numbers or size or whatever. As for the counties, the Office of the Auditor General looked at what was presented to it as 88 point, well, this is an interesting number, 88.98 billion, pending bills, of which they reported 51.3 billion were payable. So of the 88, they separated that, and there are 51.3 were payable, and the others didn't have the necessary things to assure and to confirm to the OAG that these were truly pending bills. Anyway, those also will be dealt with. But of this 51.3, of this payable amount, 30.3 were paid by January 23rd, which is, today is just a few days ago, right? So you can see there has been significant progress. The rest of it, the difference between 51 and 30, that also they are looking at. I mean, the counties are looking at those numbers or those pending bills, and a lot of them have formed committees to figure out whether these are truly pending bills and eventually have them paid appropriately. So, bottom line here, there has been progress in the pending bills. We in the central bank have seen the numbers, have seen the payments coming through, because you can see the liquidity injections and things like that. And also, in some sense, as we did in last year in June, more like July, after the substantial payments, you can tell that there is some sort of stability and noise level falls. As a matter of fact, how you find out about this is through repayment of loans. So a lot of these people probably had loans, and you see that they're making good some of their payments. So I'm just pointing some general direction. we're about to finish. So the last part is where we therefore on output, GDP. And Q1 to Q3 data, we have that already. We got the Q3 data at the end of December. And using the leading indicators for Q4 2019, we estimate GDP growth in 2019 as something like 5.7%. So 5 3/4. And also, again, project 2020 to be around 6.2. Frankly, this is a very benign baseline, 6.2. We've talked before, we've mentioned, we've made the point that there is substantial upside because of the output gap, but also because of the significant potential that still remains in terms of investments and things like that. Not just, when you talk output gap, you generally mean investments that are in place and people that are, so machines and things that can produce stuff, agriculture farms that can produce things. You're not talking of additional investments, say over time. That would increase, let's say, your production possibilities. So even with a very benign sort of projection, we'll end up at 6.2, as we have mentioned. But the point is that these numbers, beneath them or inside them, there are some concerns that could probably lead, if they are dealt with, would lead to a substantial increase in the output. So, for instance, agriculture in 2019 was weaker than we were expecting. That is significant. And we have the 4.6, we have a 4.6 growth in 2019, which frankly is below the average over the last, I think the average of, if you ignore 2019, begin with 2018 and do 5 years, it would be around 5%. So the point is, this is still below the average. And I think we understand why. Some of the sector problems that we are talking about. That said, there has been some policy pronouncements, and in particular, His Excellency the President spoke on Tuesday, January 14, and made specific policy pronouncements. And I want to flag 2 areas. One, in agriculture. There was a lot of action, a lot of policies in tea, coffee, milk, perishables. There was also action in terms of maize, but the ones that at least you could say there was significant movement were these ones that I just mentioned. There was also pronouncement in the area of micro and small and medium-sized enterprises. And the point is that if these actually are implemented, the issue for us is always implementation. So if we implement things correctly, then you can see a substantial improvement in these sectors will be reformed, will be transformed. And that would obviously lead to a significant increase in the GDP. But still, we haven't loaded that into the benign projection that I mentioned a moment ago. So, output gap, we estimated that there was still a residual output gap, and there were minimal risks to inflation going forward. As I mentioned, inflation was well anchored. Then we looked at the policy action that we took back in November, the reduction in the CBR rate by 50 basis points, and we assessed that this was still working through the economy. It takes about 4 months, or a minimum of 4 months, for a change in the interest rates in a perfect world. Well, maybe I should backtrack. We actually did look at estimates that were done about the transmission, the evolution of such a shock, right, or such a policy action. And the assessment was that it would take 4 months, minimum of 4 months, and the peak impact is something in 2 months, is around 2 months. So the November action, if you think of it, it was at the end of November. So actually it is about now that it would really be kicking in, right? And it's still transmitting itself. So that was one thing. Secondly, there was the fiscal withdrawal, which I mentioned, and this is one of the reasons I needed to belabor it and sort of say, yes, there is actually a lot of action in consolidating fiscal. And thirdly, also weigh into this or throw into the mix the policy actions that I mentioned a moment ago that were aimed at re-energizing agriculture and medium and small size, well, micro, small, and medium-sized enterprises. So on this, taking all these things together and also assessing the output gap that was there, the Monetary Policy Committee decided on a 25 basis point cut in the CBR, and that is what was announced in the papers. Well, I will stop there, and maybe there will be questions about some of the things I have here.
Please stand up, introduce yourself by name and by media house. Ask a question, preferably try one question only. You'll come back if there's any more questions to be asked. And in a situation where that question has been answered, please don't ask it again, because what that does is simply just makes the thing longer than it should be. So I saw 2 hands here. We'll start here. There's a microphone on that side. Then I see Kefa and Abby. I think those 4 first, and then we'll come back. Oh, is that David? Is your hand up? Mm-hmm. Yeah. So that's 5. So these 2, those 2, and David at the back.
So my question is about the locusts. Yeah, I'm getting to it. The thing is, we are being advised by World Bank that Africa is most likely to be hit hard with the climate change. And seeing the locusts now in especially Kenya, is this something that is likely to shy away or make investors shy away and maybe shrink the economy?
Mm-hmm. Mm-hmm.
Good morning. My name is Victoria from Metropole TV. You mentioned that you're giving the banks, you're working with the banks to give a robust plan. I'm interested to know what's the timeline you've given the banks, and the issue of the pending bills. How much is the historical bills that are yet to be paid? Thank you.
Good morning. My name is Kefa Njoroge with Radio Citizen, and my question is specific to the MPC action yesterday. It was a soft cut, 25 points. That's the first in almost a decade to be that soft. And noting that you said that the transition of the last cut would only be better after 4 months, I'm curious of where the early another injection. And with this, I'm curious of where does private sector credit stand in the post. What we got on the statement was only in the run-up to December 2019. I'm curious of where private sector credit stood in at least the 2 months, what you've observed. And with the same interest rates, because I know there was a circular issue to banks to report to you on the new interest rates, if you could just address that. Thank you.
Thank you. My name is Abi Gina from KTN. Governor, just want to get your thoughts around the impacts of Brexit. We are, of course, targeting the 31st of January. How will this impact on trade? Pretty much tied to what you had shared earlier, where we're looking at a very volatile trade environment right now for Kenya and also Africa at large. How do we insulate ourselves against these shocks? And lastly, my other question is in relation to the credit uptake in the economy. You did mention that private sector credit grew by about 7.1%. What do you focus now that we have the repeal happened? Of course, we've counted the months. We are heading to the peak month. month where you did say we should expect the full effects to kick in. If you could also weigh in on this thing.
David, I think you're somewhere. Even. There you go.
Thanks. David Abling from Bloomberg. Given the transmission concerns about the cut, banks are not, transmitting this to customers. Do you still maintain, your outlook and using outlook, and do you still see further rooms for another cut? Thanks.
Okay, maybe I begin with David's because I now remember. I don't want to finish what I was writing. I don't know. You just said that there are transmission concerns. Those could be concerns that David has. This is different. So we don't have those concerns that you seem to allude to. Any transmission of interest rate policy, cut or increase, takes time. As a matter of fact, if you recall, in the past I have made the point that at least in terms of experience or the expectation, you generally expect something like 3 months before things begin to kick in. So I think those of you that have a similar sort of concern, I think are mistaken. Let's be patient. Things take time. And if you also, I want to go back into the thing of running. When you start running, you don't start running at 100% effort. If you're going far, you sort of begin at a fast clip, but not at 100%. So things take time. Then let's go back to the locust story. I want to answer it a little different, if you may. Climate change is real. It is real. I just came back from Davos. And if you follow what I do, I did mention that I was there, and there was what I called a cacophony with regards to climate change. Frankly, this was the, like you'd say, 90% of the conversation discussions was about climate change. The only problem is it was sort of like a collision. So climate change is very, very real. And what is interesting is that we in Africa are the ones that, let's say, in terms of emitting the carbon gases and things like that, we are the ones that are doing the least. The number I recall is something like less than 4%, right? But don't quote me on that, we can check it. But in terms of impact, we are the ones that are feeling the blunt the most. In a sense, we are quote unquote least prepared. Ourselves and our Caribbean brethren are the ones that are least prepared for, or you want to say, will get the most impact. So it's something we have to do. So you asked the question from the perspective of locusts, but I think it should be a reminder. Yeah, so it should be a reminder to us that we really need to do something in terms of climate change. Now, what have we done? And I think one of the things that we have been doing, and we've talked about this, is doing green finance, doing more sustainable financing. And the banks have already started on this. They already did the sustainable financing initiative, which was launched 4 years ago, I think it was, or 2015 or 20, I think it was 2015, around 2015. Could be also early 2016, around then. And this is in effect to, well, if you want, it is actually to be more green, to make sure that the assets, meaning their lending, is going into greener projects and helping the borrowers to be more green. Not greenwashing, but to be more green, right? And we recently, as Kenya, also made a large step, a big step in this. And this was with regard to the green bond, which, as you know, was floated and listed in the Nairobi Securities Exchange. And last week was actually also cross-listed in the London Stock Exchange. And we have made the point that going forward, it must be that all our financing around the world should be green. So we need to do our part. So this is the answer to your locust story. But the locusts are obviously something that we have to deal with, because immediately, use of whatever measures. You asked whether investors will shy away. They'll only shy away if it appears like we don't know what we are doing. Of course, investors want to invest in green products. They want to invest in green financing, right? I mean, there's a lot of money in the green finance industry. But I think more than that, we want investors that want to take care of our economy, of our environment. That is essential. Why should we, in the olden days, coffee, I don't know whether you're familiar with coffee farms or coffee mills, coffee factories. They would just discharge the effluent into the stream, just like that that's crazy. I mean, that should be something that we don't do, right? So I'm just making the point that there are things that are cheap, and therefore, or rather we do things and considering more the bottom line, but then it is significant in terms of the bottom line for the planet. So we need to have investors that are like-minded, meaning who care, who want to be good stewards of the economy just like we do, because it is our job. It is really our job. Vicky asked about timelines.
Sorry.
What?
So sorry.
Oh, go ahead.
I was just asking, should we as Kenyans start to look in diversification and not just agriculture? Should we look in other areas for investments apart from agriculture, since with the climate change and everything happening around that, it might affect production?
That is true, but I think every sector will be affected. Every sector will be affected by climate change. Think of, for instance, water. Here in Nairobi, we have that problem of water. Things will get even worse. I know places in Malaysia, for instance, I think it is Bangkok, where actually they have, here you think that what you need to do is get a borehole. So in your place in wherever, get a borehole and you're okay. The trouble is the water level will also go down. And in Bangkok, actually what is happening is they've taken away the water so much. The water level has gone down, and actually the ground has collapsed. Or Jakarta, the ground has collapsed. So you can't run away from climate change. There's something we've done to make nature angry. We cannot fight nature. She'll come out winning. So it is extremely important for us to deal with these things. So it's true, diversification we should, but I think the issue is much bigger than just diversification. It should be in everything. The way we build, the way, all these things have to be dealt with. Okay, we could carry it offline later if that's not enough. Yeah. Okay, Vicky was asking about timelines. And the timelines are, we will have several rounds of conversations, right, with them. And we hope that, say, by March, April, we have had conversations with all of them. But I think the point here is we'll have conversations with them. It's like everything else. How long will it take me to, going back to the marathon story, I'm training for the marathon. How long will it take me to run 10K in so many minutes, or the marathon? It all depends on my effort. So I think the point, it goes back to the banks themselves. How much effort? Do they actually get it? In a sense, you are trying to explain to them, and I know this may not sound right. Remember, it's a bit like training somebody in a new language, right? So it also depends on how quickly how good they are in picking up the new language. There are those of us that you probably need days just to say one sentence, but there are others who, in minutes, they already have a grasp of a few statements and things like that. So we don't have a timeline if that's what you're looking for. Well, we say by this day, of course, internally we have our own timeline because of work-related things. I need to know when people are going on vacation, so I have a timeline. But and I know who is going to be doing what. But I think in terms of outcomes, it really depends on how quickly the banks get their act together and how quickly they can learn the new language. And then once they learn the new language, they're okay, and they can go and and use it and use the new tools that they have. But again, it's important to say that these are tools, these are models that are not specific only to Kenya. I hope we understand each other on that one. Meaning you are not thinking of, the banking industry has been alive for many, many centuries. We have to benefit from that. Other jurisdictions as well. We are not the first ones to begin dealing with lending and assessing risks and things like that. So we have to benefit from all that. So I think that is an important element to underscore. Okay, pending bills. Unfortunately, I didn't have that number. You are asking for the historic bills that were not, that have not been paid, that have been assessed. I don't have that number here, but I think if you could look at the BROP, maybe it will be there. That one I don't have it. Yeah. Kaifer was asked about private sector credit. Yes, that is 7.1%. And frankly, 7.1, let's say, if there were, remember we talked about the repayment, there was a reduction in non-performing loans because of repayments and write-offs, right? Half-half. Actually, if there were no write-offs, the growth would have been 7.4%. So if indeed there was no write-offs between in November and December, the growth that we would have reported, private sector credit growth would have been 7.4. Now, I'm just giving that. I'm not going to stick to 7.4. We need to stick to 7.1 because we know the benefits of of what they did, the write-offs and so forth. But in terms of the credit growth that we are projecting for the year, I'm sorry, it's in my big binder here, so it will take me a bit of time to locate it, unless you have a number. Do you have a number? 11.8. 11.8. So I hope that is okay with you, Kaifa. And this is in the context of everything, Kaifa, in the context of, say, what we are doing, including the removal of the interest rate caps, meaning we no longer, the current regime. So 11.8. Abi asked about Brexit. All I can say is we spent a bit of time in the UK, Monday last week, right? And attending the UK Africa Summit. What is clear is that the UK has, in my view, awoken to the fact that they turned their back on us. I'm not talking Kenya now, I'm talking Africa, more generally the Commonwealth, right? And they realized that, maybe we need to, it is in their interest to again rebuild this relationship. We, on the other hand, the delegates that were there, obviously see this as an opportunity to work with somebody, a partner who has been with us in the past, who has been a good partner, but we can strengthen the relationship and therefore to our benefit, right? So that is clear. So then in the midst of all this, you have Brexit. So it just means that first and foremost, we will have a sort of a transition arrangement where nothing will happen in terms of, there will be no change in our trade regime. So things will remain as is. Let's say that they leave the EU and therefore begin to do their own external, let's say, regimes, external trade regime and things like that. We will have exactly the same regime as we have today. And they've assured us of that. And then, of course, they'll have to do all the agreements with the, let's say, the other economies. Now, they announced that it will be the EU. They'll begin negotiating with the EU, the trade regime. The US, on the other hand, said, well, we thought we were number one. So there's a little fight as to whether it's the EU and the US, but they'll sort themselves out, right? But eventually they'll do all the agreements, and eventually will get to us. So a few years later, at a minimum, these things take a long time. I mean, so I don't think there's a rush in that sense. But so from the perspective of trade, I don't think there'll be too much of a concern because of the assurances that we got, and which reinforced assurances that we got that were presented to the government, quite some time ago. You remember there was a very high-profile visit to Kenya, I guess a couple of years ago now, something like that. That's one. There is another element to this, which is foreign direct investment. This is where actually things can be a bit messy, because these are private sector decisions, and they are, on the one hand, they may be rearing from the impact of Brexit. So think of an institution that is in the UK, that is based in the UK, and so they may want to move their people to, I don't know, Ireland, or they may want to move their people to Brussels, I don't know. So they have to first deal with their own in-house things before they make the decision how much they want to invest in the African jurisdictions or African things. This is why it was important to have that conversation with investors in the UK, so that they fully understand that we're here, what we have to offer. And as you know, after the meeting, after the UK-Africa summit, that was on Monday. On Tuesday, there was a meeting with Kenya, had a meeting with the business lobbies and business community in the UK. So again, making that point. So I hope I've elaborated enough for you. How we insulate ourselves, exactly as I have explained. And I think I cannot focus Brexit, neither can you. So let's just hold tight and see what happens, right? I think I've answered all questions.
Just making a follow-up.
You need to stand up and say your name and your thing.
Okay, George, just making a follow-up question with regard to the way forward with how banks will be determining interest rates with different clients. And it looks like we're moving to a situation where it will no longer be a one-size-fits-all, because that's what used to happen in the past. And I just want to confirm that that's the case. That's what you're working with the banks to do right now.
Okay, let me answer this on George.
Hold that.
Do you mind? It will not be, it should not be one size fits all. It cannot be, because we all have different risk profiles. I think the best example of this is my chicken farm example. It is exactly a chicken farming business. And I am starting it. I'm very risky. I know nothing about chicken. And this farmer here with gumboots and all that knows everything about chicken. He is not as risky as I am. Therefore, I have to pay a higher price, a premium, because I'm more risky. I know nothing about chicken. He, on the other hand, needs to be given a better rate because he knows so much about chicken and he can handle. So the project is less risky if he's doing it, but if I'm doing it, it's extremely risky. So it's really that. And it cannot be just an assessment of, you are who? Yeah, you're such and such. We'll give you X amount, just a random thing. It has to be thought out correctly. And frankly, it's not just about the assessment on the person. It's also on where the economy is going. So there are many factors that go into these things. But this is why they are bankers. I mean, if they thought, every profession has a whole bunch of, you have to do serious banking, not lazy banking, and I think that is the issue. We were doing lazy banking before. That is what it was. So now it is, no, you need to do, so they need to talk to us so that we see that they are doing serious banking. And, let's give them the training wheels, if you remember those things, so they can, those that actually don't have it all together in a sense, put some training wheels on them so that they can move and get used to the new environment. It's more that than anything else. Hope I've answered your question, George.
My name is Brian Lugu from the Business Daily. Just a follow-up question to the rate cap issue. When the rate cap law was lifted, and please put in a clause that all contracts should not be changed, and that the formula would be CBR +4. But we've seen when you cut the rates and signal the banks, we've not lowered the rates and retain them at 13%. Do you see this as a manifestation of the Wild West tactics you've been speaking about, or as a lag in the transmission that you asked for patience? Thanks.
Right. Yes, no, I don't hear you.
Good morning. My name is Njoroge from East African. I know you've not been very good terms with the IMF. And I know last year you started the negotiation on a standby facility. How far are you back to negotiations? Do you expect it to come through this year, and when?
All right, then choose one person there.
Good morning, Julia Rina from Capital River.
Please hold the microphone closer, I can't hear you.
Julia Rina from Capital River. Just on the same question to the banks, you spoke, you mentioned that you started working with some of them. And I just wanted to understand if there are any that have already presented their models, if at all there are any that have already started presenting their plan on how they're going to get to their plans. Is there anyone who's already met the cut, or you send them back home to go and work?
All right, one last one.
My name is Evelyn. I work with Al Jazeera. Allow me to ask. You mentioned about the pending bills and the sort of impact those bills have been having on the economy in terms of liquidity. And in IMF's report, the fiscal transparency evaluation, they raised concerns about how many projects, government infrastructure projects, have stalled. They were talking figures of about 1,000 big projects or 500 big projects that are still in the pipeline. What's the big plan on all these projects that are stalled, and what sort of impact is that having on your books?
All right, thank you.
Okay, let's begin with Brian. Brian, I think I would only suggest that you look at the law again, because what you read to me is not the law. So I'll just stop there. Giraini asked about IMF negotiations. This we have to understand this, right? Because I've made this point many times. Maybe it should be made many more times. First, let's understand why is it that we are having conversations with the IMF. Obviously, we have to have conversations with them because we are members of the IMF, just like any institution, right? But more than that, in this particular case, we are talking of, so that is the context of regular relations with the IMF. Article 4 consultations and things like that. Then you have another level of engagement, which is where you are engaging in the context of a program where there could be financing associated with it. And that, I think, is what Jirain is asking. So, and that I have made the point that for us, it is beneficial to have, and I've used the words insurance, because the world is now a very risky place. So we want to have insurance for extreme events. I don't want to call them black swan or something like that, but extreme events. I mean, we have reserves, we have policy maneuver, we have room to maneuver policy. But I think if things really went south, very bad, then we would need to take out, we would need insurance, the payout on an insurance. And that's why it's important to get insurance. And you should get insurance, as we all know, before you need it. So the car insurance, for instance, you better have it before. I mean, there's no point in trying to get insurance after you've had the accident. That doesn't work, right? So it is important to be clear about that. So that's why we have been engaging in this conversation with them. From our perspective, we want it to be precautionary. So this isn't a bailout in your jargon. Yeah, it's not a bailout in the terms of a country in crisis and wants to be put in balance of payments problems, wants to be put in a sort of a better sort of trajectory. That's not the case here. All we know is that there may be that occasion, and therefore we want to hold that insurance just so that it can pay out when we have serious concerns. And so we will have conversation. We have had conversations, and they'll be coming later this year. I mean, later in this quarter, sometime this quarter. So we are at the end of January. So we are talking February, March, sometime then. But I mean, whether we conclude the discussions in one shot or we are more relaxed. I don't know why everybody gets a sense that we should do this in a rush. I don't know. I just don't understand that logic. But the bottom line is, Jiraini, the answer is sometime this quarter, in the next couple of months, there will be, we'll have discussions again with them. There'll be a mission, they'll come, and we'll have a conversation, and then continue the conversation. Hopefully, we will end up getting insurance that is good for us. And that will protect us, say, for the next, into the future for a period of time. Judy, I don't remember your question. Yes.
I mentioned, but you equally mentioned that there's some banks you already started.
Yes. Thank you. The point is that we have already been having these discussions. And there are, banks are at different points, right? So I cannot today tell you that this bank has finished and this one has not. But I think the point here is that all of them understand what business we are doing with them, right? And we are there to support them. You understand? We as the regulator are there to support them. But at this moment, I cannot tell you that Bank X has finished and Bank Y we have yet to start. But obviously, what we have generally done is to be a bit more risk-based. We tend to be risk-based. So you begin with the large ones. Or maybe you test it with the small ones and then go to the big ones. So anyway, but you understand what I'm saying. So at this moment, I don't think I can tell you, I can give you the identity of institutions that we have completed. But just appreciate that we are moving forward, and there are no concerns with the banks themselves. And frankly, a lot of them have options. They have options in terms of models. I mean, I think DG can tell us what she used to do when she was working there. And they have options. So in a sense, it also helps to get the regulators' opinion, that, yeah, this one looks better because of this. Because we have a sort of bird's eye view of the sector, which banks may not always have. Now, Heidi asked about projects, right, and things like that. First, I would say that I was trying to not indicate my disappointment. But now that you've asked me, I'll tell you my disappointment. I did read a lot of articles in your newspapers. Now, I'm not talking of Al Jazeera. I'm talking generally, right? Al Jazeera doesn't have a newspaper. And maybe I should follow Al Jazeera on Twitter or something, right? But what is clear is that there were a lot of articles that were written, I think, last week, maybe even the week before, and about this report that was issued by the IMF. It's really the Fiscal Transparency Evaluation Update for Kenya. And those articles really, in my view, missed the boat. I have seen the report. To say I've seen it is obviously an understatement. The articles that are there were writing about those things were, in my view, erroneous. And we've made this point to some of your bosses, because it doesn't make sense. If we are going to work even conversations like this, I don't expect us to agree on everything, but I expect us to be fair. I expect us to be truthful. And if things are written in a particular way, let's stick to that. Let's stick to that. Let's not create other narratives around that report. Now, just to tell you about the report, I'm not answering your question directly, Heidi, but let's say that this is a report that came from a request that the government actually made. So the National Treasury and indeed ourselves as the authorities. And the idea here was to assess, right? To assess the various aspects of fiscal transparency, or rather fiscal transparency practices in our fiscal, on our fiscal policy and other fiscal area. And this is in accordance to, or against, let's say, what you call standard, let's say, international practices, best practices. And that is important. So it is like a health check upon the request of the government itself to do this health check. And there were some factors. There were maybe 36 principles that are looked at, and they scored us against those principles. So there are some that did well, others not so well, others poorly. But remember, we are on a journey, right? If you don't know what you need to fix, again, going to the marathon story, if I don't know what I need to do in order to run, faster and do the marathon, I'm lost. And the best thing is to actually have it out there, right? For me to know what exactly is, and then for everybody, why hide it? I actually think this was a major sort of step forward, which is, okay, the doctor tells me that these are the things that I have issues with. Look at it. You understand? I actually thought it was a brave sort of maneuver, rather than sort of, they could have decided not to publish it. And then all those articles would never have happened. But I think we would have lost a lot. So I think this is the thrust of that article, of that update. And that's why the government, in a sense, did not worry putting it out, right? Now, in terms of the projects, I think we didn't need the IMF to tell us that, right? I'm not going back to your point of the 1,000 projects or whatever. All you have to do is to go into any jurisdiction right? Or any, I'm talking of county and all that. And you'll see schools that are half finished, right? You'll see clinics that, maybe they're finished because they have a roof, but they don't have windows, they don't have, we can even, I just now was thinking of other projects, the Wayaki, what is it called? Raira Road, not Raira Road, it's, what is it called? I'm sorry, you need to delete certain things, right? Red Hill Road, isn't that what it's, Red Hill to Wayaki Way? Yesterday the wall collapsed, right? A big wall. You cannot tell me that that project was well done, or it was completed correctly. There are significant things. Actually, you have photos of the bicycle path, and there are huge cracks, which have only taken place in the last 6 months, or however long that road has been open. So I don't think the issue for me is whether the projects have been finished or not. That is even just the beginning. How well were the projects done? Which is a big issue, right? We have roads, they're finished, and in a few months, we have potholes all over. So I think there are significant issues in the way we are managing projects. And I think that is what this report sort of points towards. We didn't need the IMF to tell us that. And frankly, if we are hiding that, then we are lost. Because those are projects that we need to, anyway. So I think I've made my point well. But I think this problem of investments is something that we need to deal with, because we have spent serious money that could have been used for other purposes, either as revenues or whatever, or we have borrowed, and then there's no outcome to commensurate with the borrowing that we have undertaken, because the outcome is it has potholes, it has all those other problems. It better be that when we do something, it's there to stay, and it's something that we are proud of, and something that years from now will be helping the productivity of the economy. Other questions, please.
Alex Moni from NTG.
Yes, Alex.
Just want to find out to what extent are members of the public using the information that you helped banks institute on the interest rates that they are charging. Are they using the data to compare and take advantage of it? And in line with that, are banks still also on a monthly basis or continuously posting that data?
Good afternoon. My name is Wayne Awam from the Standard. I want to take you back to the banking sector. I wanted your perspective on financing of real estate. Should we be worried that maybe banks are taking a big hit from the high rate of defaults in the sector? And also, during the President Uhuru Kenyatta's address, he directed you to take stern action against predatory lenders. On that front, what measures have you maybe perhaps instituted, and any warnings or action to any lenders?
Good afternoon, Governor. Jimmy Bogo from K24. My question, actually I have two questions. Number one is with regards to NPLs. Is it possible to get the figure of where the NPLs stand cumulatively currently? And number two, the value of what was recovered. That is one question.
Sorry, number two is?
The value of what was recovered to reduce the NPLs to the loan ratio. And the other question is with regards to the...
Go ahead, please. Yeah.
All right, with regards to the rate cap, is the CBK going to issue sort of a guideline in terms of the metric that banks should use going forward to determine how much they're going to charge?
What's actually follow-up is just my concluding questions. It's only two of them. Maybe it's on our side as reporters who struggle to find the fiscal consolidation being, purported by the National Treasury. And I'm curious of whether that's a case of what you said, it's a marathon, we start slow. And on the same, the IMF, some of the beta pills, the same doses they always recommend, like raising taxes on essential commodities. Last one is on the report you put out on the shilling, an evaluation of the shilling. Do you know how to make an interpretation of it? Is it an MPC document? Is it a working paper? And maybe, sorry, the approach you used, I don't know why it wasn't so conclusive on whether it didn't clear up the management questions that we've seen IMF and World Bank still raise, but it was clear on the undervaluation.
Question is on internal borrowing, especially the private sector. How far are we on that? Is it safe for the government to continue borrowing from them?
Thanks, David Adlin from Bloomberg. Do you see, moving forward, do you see more room for easing? Is the MPC taking a dovish stance, or are you likely to? Last year you appeared to be a bit hawkish. Moving forward, what kind of stance are you looking at? And then you mentioned diaspora remittances. Could you give your projection for 2020?
No.
And then you haven't said anything about the NYS probe on banks. You had said we'll give you more time, but it looks like that file has gone cold. And then lastly from me is the question of, could you give us the status of Charterhouse Bank? What action is CBK taking to resolve that bank? It's been many years. Thanks.
Thank you, Governor.
Okay, fine. So Alex was asking about the new information. We haven't gone back to the private sector or to the wananchi and asked them how they're using this information. And frankly, that is something that we need to do. But more than go back to them, we need to remind them to use this information. That, I think, is the more important element there. Sure, we write essays, we remind them in press conferences like this, but at the end of the day, it doesn't mean that everybody is using it. I mean, I would ask you, would you? Have you? That's the question. So I think for me, we have an obligation to remind the population, but also you have an obligation to tell them that there is that information. You can point them if they want to understand how exactly we are dealing with in the new regime, how we are dealing with it. You can point them to the things we've written. And when they go to talk to the bankers, well, they need to go armed with the information that is available or is being made available. And in the past, that wasn't the case. You did ask whether there is the information that used to be put out in the past will continue to put it out. And the answer is yes. You just go to the website. That website is there, and the information is let's say populated in the appropriate place. I hope with time that the delay will be shortened. I think now there's something like 2 months delay, but I think it's something that is a work in progress, and I think consumers need to benefit from that. So banks are reporting. They are reporting. We have required them to make reports to us on a monthly basis on where their lending is going and and the rates and things like that. So Wainaina was asking about the real estate finance. You see, you ask a regulator about a problem. It's kind of bad because we see problems everywhere as regulators. We are the only people that, I could be walking out with you, right? Today it's sunny. And you say, hey, Governor, it's such a sunny day. And then I'll say, yes, but you know what? It may rain in the afternoon. You understand? So we have this bias about risk. So, and it is good. Somebody has to worry about those things. Just like in any family, there's somebody, generally it's the mothers that worry about the bad things, the bad outcomes. The child falling and knocking his head or whatever else it is. So from our perspective, it isn't just the real estate, it's everything. And this is why we think it is important for banks to make right decisions at the beginning, not at the end. So in a sense, they cannot be overextended in a particular sector. It wasn't just real estate. Frankly, the banks don't, it's sort of other things as well, right? Remember, even as an economy, we're talking of diversification. The point I talked about, diversification of direction of trade. It is important. So we are not, in a sense, concerned only by real estate. We are concerned of any concentration in terms of investments that any institution may have, not just banks, others as well. And frankly, this is the one thing that we as economists never understand. I've never understood, this is an argument we've had. As economists, we argue about diversification, but if you look at our personal portfolios, we are very heavy in a particular investment. For instance, housing. We put a lot of our wealth in housing. Your own house, the house that you're living in. I'm assuming the car is not the same value as the house, right? So I think diversification is something that we need to remind the banks and remind everyone else. You asked about the president's statement in his policy directive. First, I need to clarify, and I'll read it as it was. He urged the central bank to use the full range of instruments of regulation and policies at its disposal to prevent predatory lending and to ensure that banks can offer loans at affordable interest rates. I think we've done a lot of the second part. As for the first part, predatory lending, goja tu. We've made that point before. Because things are bad. You have all these online lenders that, frankly, it's amazing that they still believe that they can get away with it. So, goja tu. We'll see. Jimmy was asking about NPLs and how much was recovered. The number, I want to say 7 or 4, which one was it? And it's something like that, 7 billion. So a number like that, grosso modo, somewhere around there. That was the recovery. But I think the point is, I don't think the number is the one that should bother you, Jimmy. I don't think it's the number that should bother you. I think what you should know is you have information about, a lot of information about the other institutions, which institutions they were in. Because you've seen a lot of the, in the media and other conversations that have taken place about specific borrowers that are being sorted, I'm not talking personal borrowers, I'm talking, most of us don't borrow $1 billion. You understand? You have to be a large institution to borrow that sort of level. So I think those are the institutions that are being, their loans are being dealt with, either being recovered or being written off, because, think of, for instance, Nakumat. What are you going to do with Nakumat if it has now been put under receivership and been closed and all those other things? You understand? So those things need to be dealt with according to the law. It doesn't mean, though, that when a loan is written off, the borrower goes scot-free. No, it is actually put sort of off the books, and the bank continues to follow. So you're not given a sort of a free pass just because it has been. Actually, you probably don't even know that it has been written off because they continue to follow you aggressively, as part of their bad book, or bad books. Okay, guidelines on rate caps. I think we have given enough guidelines on everything under the sun, including what they need to do here. So I don't think the issue is guidelines. I think the issue is practice. I mean, going back to the things that somebody was asking, it's really more implementing, them understanding how to go about banking business, assessing interest rates and things like that, or assessing the risk of the particular individual or borrower and things like that. So it's more doing business rather than anything else. Kaifa asked about fiscal consolidation. I don't know. I didn't quite understand your question. Now, don't repeat it. But I didn't understand your question because it betrays a sense of you don't believe that they're going to do it. You know, that sort of thing. I don't know if the issue is believe or not believe. You know, that doesn't matter. The issue is, are they doing it or are they not doing it? And I already gave you some numbers to indicate at least that the needle is going in the right direction, right? So it's more that than anything else. And the question is, are the plans sort of solid? I mean, is there a sort of solid basis, or are we back again in abracadabra? You know, if you remember what I said last time. So it is more that. And I think here is where the assessment is, this looks like a solid plan. So let's give it a chance to succeed. And if it succeeds, then the outcomes will be as indicated. I talked about the reduction in deficit, in their fiscal deficit. So that will be the outcome that we'll see in the end. But we won't know this until June. I mean, we'll see the direction they are going. We now have 6 months. We have another 6 months to go. So I think it is more that than just dismissing it out of hand because, you know, the last 500 years, nothing happened. So even this time, you know, why should things be different? You know, so I hope I've answered you. I don't also understand what you mean by the IMF bitter pill. It is bitter pill if you don't have control on what you're doing. But why should you have different policies from the ones that you want? It's either you're in control or you're not. If you're in control, you'll do what you think is best for the economy. And there are things that are hard, for sure. For sure. But in the end, they are good for the economy. So I don't think the issue is bitter pill or not. They are good policies. But I think the issue for me is, are you doing them because you want them or because somebody else is pushing it? Now, if you wait, which is what happens, now we are talking of sort of an economy that is in desperate need, right? And you can choose whatever name you want, that economy that you know, that is in dire need. Now, obviously, the adjustment will need to be significant. And so that's where the bitterness of the pill, of the medicine comes in. But I think at the end of the day, it's you who has to decide what, the policymakers, they're the ones that need to decide what should work, what should be part of the policy package. And why should the policy package be different, whether you're in an IMF program or you're outside an IMF program? It should be the same. So it is that sort of sense of, let's say, confidence that we know what we are doing. We don't need somebody to come and tell us, you know, here's a document signed by the dotted line. It shouldn't work that way. And frankly, here in Kenya, it won't work that way. Not on our watch. Okay. Fine. And you asked about docs. I don't know what to say. I don't know what your question was. What? Oh, that. Yeah, what sort of a report it was. Well, you see, the problem here is we don't have what I would call various lines of papers, right? So working paper, staff note, discussion paper. We don't have all those labels. Everything is mixed, you know, very kienyeji. Everything is in there, and it just is. And just say that this is a report that has been written by the research department, staff in the research department, has been reviewed by us, and by management, and has been authorized to be published by management. It's as simple as that. Whether that's a discussion paper and all that, I don't know what to say. But the bottom line is that whatever is there has the clearance or the, I mean, we believe that that tells the story of the IMF, against our story, which was the issue that we were trying to get at. So it tells the CBK story against the other questions that were there before. And I hope that much it comes through. Now, it is a bit complicated. And the reason is because, I mean, they need to sort of show their worth, you know. So, but you can, we asked you, I mean, we actually summarized it. I summarized it, however many, is it a year ago when I spoke? And I thought that was plain English. But then you wanted a report. So you got a report. Now it is in gobbledygook. Well, fine, you know. But I think as technically that report can be read by anybody. And therefore, if there are any concerns, one can look at it and explain. But I don't think the point there was to stifle conversation. On the contrary, it was supposed to help continue or generate the conversation. Sophia asked about borrowing for government. If there's anything I didn't say, it's really about this. And all I can say is that actually the government has continued to borrow domestically. The target we have is 300.3 billion. That's the target domestic borrowing for the year, fiscal year, right? So to end June. And we are well past the run rate. So we are doing better than average. You understand what I'm saying? I know there are concerns, and now I'm extrapolating your question. There are concerns earlier that some of you also wrote about, found them curious, to say the least, that the government was having trouble borrowing. And that's because, I assume, it was because there were some auctions that were undersubscribed. And these are mainly the T-bill option. Actually, what whoever wrote those articles and those headlines missed to say is that actually there is a policy of switching from T-bills to T-bonds. Meaning, and that's what we were trying to do. So even as we are trying to get 300.3 billion, we want to have less and less of T-bills and more of the bonds. Why? So as to lengthen the duration of our borrowing. So the average time to maturity of our portfolio needs to be lengthened. And actually we've succeeded in doing that. That to me is praiseworthy. So that is and if you've seen, for instance, in the last auction, the bond auction, I mean, it was heavily oversubscribed. So the markets understand what we are doing. So I think the point here is that we are not concerned about, let's say, there being sort of people flight away from government paper. On the contrary, but also we are not concerned about crowding out, which is a concern that some of us may have as well. That maybe government is borrowing too much and therefore crowding out the private sector, and therefore the 7.1% won't happen, won't get the 11% because the government is, no, actually our program shows that we can accommodate it quite comfortably. As a matter of fact, there's a lot of room in terms of increase in lending that can take place. So I hope I've answered your question. But I think one of the bright spots so far in the last 6 months has been the improvement in the profile of government debt, domestic government debt. You know, away from T-bills and more into bonds. The other points one could make, but I want to stop there. While we are at this, there's also, now David asked more room for easing. You know, I don't have a crystal ball. So why don't we cross that bridge when we get to it? Because at the end of the day, we are very much data dependent. The decisions, as we have said before, are data driven. So let's get the data. In 2 months, we'll be here. We'll look at the data and then we'll see. Let's not speculate. Let's not anticipate. By the way, I did get a similar question by your colleague a week ago. Exactly the same thing. Will there be room for easing? And she was asking about this meeting that happened yesterday. And I gave her exactly the same answer as you. You could compare notes if you want. Man, I'm lost. I think I know what I'm looking for. So let me just stay within my lanes. Let me stay within my lane. And I know what I'm looking for. Okay, I think this looks better. So remittances, what we expect is a stabilization in terms of GDP, share of GDP. So it is around 2.9% of GDP now, and it will be around there, 2.9, 2.8% of GDP. In terms of Kenya shillings, US dollars. So we expect a slight growth, or growth of, I forget how much in terms of percentage, to something like 2.9, well, actually about 3 billion in 2020. Okay, 29992. It's just 3 billion. Okay. NYS probe on banks. Well, let's just punt that into the future. Let's see, at the right time we'll have more information. Today I don't have information. You asked about Charterhouse Bank. Again, this one I have no news to report. I do understand how long this has taken. I do understand that this thing is in the courts. So I have nothing new to report. The only other one which I think I should put on the table is Imperial Bank. You remember that bank, and for some time now we announced in April of 2019 that there will be another dividend disbursement that was going to be paid, and I think the depositors have waited, and we had said that this would be paid quickly, and it was going to be facilitated through KCB, KCB Bank, and I think you understand how that was going to happen. And it was going to be a dividend of a certain amount, and so there has been pressure. You've been asking us about this, and now I can say that nothing stands in the way for this payment. So let your depositors hear that. Let your readers hear that. Nothing stands in the way. Now, who pays them? Of course, they can go and ask KDIC. Any other questions, Mr. Wallace? None. Okay, Jimmy.
Is it life and death? Life and death? No.
Okay, Jimmy, quickly clarify what your question is. NPLs.
Yeah, where they currently stand cumulatively for.
Yeah, I don't remember why it is. We'll give you the number. Yeah. Is that okay? Yeah. I'm not always well equipped, and I only have one arm to carry all these documents. Okay, so thank you very much. Again, thank you for coming, and I look forward to engaging with you more this year. I really do. There's a lot of work that we can do, but I think a lot of it starts with our engagement, you and I. So let's do that. Let's carry it forward. Thank you very much.